Hi, I'm Lyn Adams.
I'm Justin Gross.
Welcome to this edition of Video Insight. This is our fourth quarter client conference call for 2016. We appreciate you taking time to check in with us, and we want to give you an update on what's going on in the markets and a few ideas about the landscape of the financial world. So with that, we'll jump in. It's important to note that everything that we talk about really is for educational purposes only. It's not intended to be construed as investment advice, and we really just want to give you a good background of the things that we're looking at day to day as we manage different portfolios for our clients. So with that, if you look carefully here, this is a snapshot of the returns for the year through September 30th, and we can see through the end of September, the best performing sector, interestingly, is emerging markets. It's up 16.4%. I think it's important to note with emerging markets, that's still quite a bit off of where they were at the beginning of last year. They had a very significant downturn last year, so reversion to the mean, still not back to previous highs. But nonetheless, this year, good number. Small cap stocks here in the U.S. have also done pretty well through the third quarter, up 11.5%. Commodities, which include your natural resources, your materials, energy, those are up 8.9% as a whole. The U.S. stock market, as measured by the S&P 500, is up just under 8%, 7.8%. The bond market, up another 5.8%. That's probably a surprise because interest rates started the year pretty low, and now they're yet even lower. And so that's, you can't complain with a 5% return on a bond that's yielding 1 point something. That's what most bonds are at. The EFI, which is your international developed world stock market's up 2, and then the hedge fund community, the blended composite for hedge funds, is up. Actually, it's negative 0.6. So all in all, I think regardless of how aggressive or conservative you are, this has been a good year for your returns in the market because everything is up through the end of September. That being said, if we switch over here and look at our chart here of the aging bull meandering on, we are now in the 8th year of this continued bull market. And as we look at the S&P 500, if we look at the stocks that are in there in terms of the valuations, the current price to earnings ratio for the 500 largest companies in America, when they look forward, is about 16 times annual earnings. We've identified here this trend since late 13, this sort of trading range with these dotted lines where the market has been in this trading range for quite some time. In the summer, we actually have broke out of this to the top of that trend, and a lot of technical folks would say, that's a positive. It is suggesting that there's potential for more growth. I think the challenge is that we know that the Federal Reserve is poised to raise interest rates because they don't want to maintain this super low interest rate policy indefinitely.
Which is obviously a reversal from what we've seen over the last 8 years of lowering quantitative easing, and it's interesting kind of that sideways trend began to develop when that stopped.
Right when they said we're going to raise rates, which was the end of 13, we've been in this sideways pattern. And of course they did raise once. They're, I guess, now talking about raising again in December. But every time we get some forward momentum in the market, our expectation here is that the Fed will raise as they can, and that would provide a headwind. So this sideways trading, unfortunately, may be something we're going to have to live with for a while. I would point out here something that's interesting. If you look at this, the data in this chart, the yield on the S&P dividend is 2.2%. And that is a higher yield than it was in October of 07 or back in 2000. And the reason that's significant is if you look at the 10-year Treasury yield, 10-year Treasury is only at 1.6, whereas back in 07 it was at 4 and back in 2000 it was at 6. There is a lot of activity in the stock market this year where people, I think, are buying dividend-paying stocks as a proxy for bonds. They want the yield. We're living in a yield-starved environment. So I think because interest rates are so low globally, there's a certain amount of demand for stocks that's going to be intrinsic. People just buying it for the yield. And I don't know that that's healthy, but that's part of, I think, what's pushed this breakout to the top.
Yeah, and we continue to focus on that sector, the defensive-oriented, minimum volatility type, name stocks that people probably are buying for yield. And when that returns, that we have to be careful for that. So
Yeah, those are
we're on
getting pretty
watch.
expensive. But if you look at the market as a whole, stock prices, look slightly elevated. 16 times earnings against a long-term average of 15. It's above the long-term average, but not grossly above the long-term average. Certainly not like it was in 2000 when we had the dot-com mania going on. One thing I think that is of interest at this moment, looks good on paper for sure, is that earnings year over year have turned positive, right? So if you look at this chart here, it shows us that really since the mid part of 2013, earnings have been on the decline up until second quarter of 2016, and now they actually have gone up. They're basing that against last year's earnings, and the chart on the right here shows us that really the culprit is energy, right? Energy losses were just massive, and that's one of the sectors in the S&P. And now that they have seen energy consolidate, a lot of companies bought out, big fish ate the little fish, there's less companies, they're holding the prices steady. Energy earnings are coming back. I don't know that they're going to expect it to get back to the $3 a share earnings that they were at back in 12 and 13, but even $1 a share is a positive contribution for energy, which is part of the reason the forecast for the S&P earnings is looking so good at this particular time, which is, hey, the market trades on earnings. It's part of the picture, right? You're buying your claim to those earnings when you buy a stock. That is why people own stocks in the long run.
And energy is a far-reaching sector. It touches everything.
Right.
If you ship something, if you make something, if you anything, energy touches it. So it's a big deal.
It is.
And it looks like it's turning around for us.
If you look at this next slide, one of the things I thought was really interesting this quarter was that there's sort of a new trend emerging. So as we mentioned just a minute ago, the defensive stocks, the things like the consumer staples, Clorox, J&J, Kimberly-Clark make toilet paper, those stocks have been trading at unbelievably high prices. Earlier in the year, Clorox was at like 30 times earnings. And our belief is that people are paying that because they want the dividend and they want the perceived safety of that brand. Well, the defensive stocks and essentially the cyclical stocks have been trading together up until this summer. And in July, we started to see the IT, the financials, the materials begin to kind of move forward a little bit more at the same time that some of those staples and defensive brands, utilities, are backing off of their recent highs. So anytime we see something trade together for a period of time and then suddenly have a divergence, we want to take note because the market's trying to tell us something. It's forecasting, I think it's forecasting a spike up in growth, in actual organic growth. But again, it could be squashed by rising interest rates.
And it's a balance between cyclical growth or, hey, should we really be paying this much for
right.
Q-tips and cotton balls?
Right.
So
to apply that though, so in our strategies, we would bias maybe a little bit more of the growthier types of sectors and maybe have a little less exposure to the more defensive sectors, because we can see that the defensive sectors are losing some support. If you're looking at your 401k and you've got choices between like growth versus value, if you believe that this trend is identifying something that might continue, you might want to have a little bit more in growth versus value within the same stock universe. Just a thought for what it's worth. All that said, we cannot lose sight of the reality that volatility is normal, and we need to keep in mind it's not going to go away, and we need to expect it. Now this year, earlier in the year, we talked about this in the second quarter call, even the third quarter call as well, but in January we had the worst January ever, like minus 11% in 1 month. That's pretty bad. And you can see that on this chart, minus 11, minus 15, minus 10, those are pretty normal entry year declines. All of the ingredients are present to create a lot of volatility. We've got a lot of political theater going on. We have a pretty stable interest rate environment. We haven't had a lot of global disruptions in trade. We did just have a pretty massive hurricane hit the East Coast, but in terms of like natural disasters that can take things offline, I think that we need to expect there's a lot of things that could cause some volatility here. So don't freak out if it happens. Just know it's part of investing in stocks and being in it for the long run.
And then one thing to note, that volatility creates opportunities.
That's right.
Okay, so it's not altogether a bad thing. It's actually a good thing, and we need it with some of our strategies. So it's
right
to be prepared for it, and just know that it's a part, and it's not going away. It can lay dormant, but
right.
it's there.
No, in fact, our defined risk strategy, I mean, if we didn't have volatility, it would never really prove to be a good strategy.
No.
Right? You know, it's designed to let us pull out a little bit of the market when we trend under the 200-day moving average and prices fall from there. We get the opportunity perhaps later to come back in at a lower price. So you need volatility to create opportunity, as Justin said. Globally, cheap money is still a big headline, and I think it's just so critically important that people understand the uniqueness of this time period. You know, if I take my money today and I give it to the government for 10 years and they pay me 1.6% interest for 10 years, and then I take that and I compare it to what I can purchase with inflation, I'm actually losing 0.75% a year in purchasing power, right? It is very, very unusual to have, you know, our government core interest rates such that we lose spending power to inflation after we get our money back. And that didn't count taxes, because we pay taxes too. What's really crazy about it is that we're still one of the highest in the world at 1.6% on the 10-year Treasury. Of all the sovereigns, that's probably one of the highest out there. So since there's such low interest rates throughout the whole world, it'd be hard to imagine interest rates rising quickly, but we do know they have to rise at some pace. It's hard to know, but it's very, very cheap. And it's creating some very funky things, right? Here's a chart where look at the relationship between interest rates, stock prices, and other things. But just take, for example, we want to help you understand how interest rates and stock prices are connected. If you're a saver and you save $100,000, and just back in 10 years ago, you go to the bank and you put your money in the bank, say in 2006, you get $5,000 in interest off that $100,000 for the year. Today, you take that same $100,000 to the bank, you're going to get $300 in interest, or $370 or $360. You can't live on that. It's not enough. So because of that, you have to find something else. Investors are having to find something else to put their money in. And I think they're finding the defensive stocks, the high dividend stocks, and they're pouring the money into there, and it's creating, in my opinion, somewhat of a bubble in that space.
Well, it's creating, in my opinion, a whole sect of investors that are not really investors. They're savers.
Right.
They're used to getting 4 or 5% on a CD. They don't want the volatility, but they want the $5,000 a year. They want the interest.
Right.
So they're going to go find the interest. Where's it at? It's in those high dividend payers, so-called conservative minimal volatility stocks. And when that turns, I think you see those people
running
leave
for the door.
because I want my interest, but I don't want the volatility that comes with stocks that they just haven't seen in some time.
Yeah, I don't think maybe bubble's not the right word. I do think that when you have an underappreciation of the risk that you're taking, and a lot of people do it at the same time, that's when you get challenges when things change. And I think that is a major concern in those defensive stocks right now. Another thing that would help us to understand the relationship between interest rates and stock prices is if you look at how corporations use this cheap money, right? If I make widgets and I have so much money in the bank to go out and manufacture my widgets and go and sell them, if I can borrow money for pennies on the dollar and make 10 times more widgets, then I can make a lot more money on somebody else's capital, right? So if you look at this chart, this is showing us that the amount of leverage used in corporate financing of their operations is now back to 45% of corporate balance sheets are actually leveraged. They're borrowing money to grow and operate their businesses. The last couple of times that we saw that amount of leverage being applied to corporate profits and corporate growth was 2007, 8, and 9, and back in 2001 and 2. And we all know in those periods of time what came thereafter was deleveraging. So I am a little bit fearful here that there's so much leverage being used, borrowed money to grow, that when interest rates begin to slide up, or the growth begins to slide down and people deleverage, that it could be a pretty unhappy period of time, right?
Another reason for volatility.
Yeah,
it
yeah.
could be there. It's going to be there at some point.
Not the end of the world,
No, it's
but
fine,
but
yeah.
but certainly could make the case for a significant correction.
Yep.
Right. So this last chart, we showed this in the mid-year market update, but this is, and this is a little abstract, so try to follow this here. So in the long term of things, people would pay on the right-hand side here, as earnings go up, GDP earnings go up, growth goes up, stock prices go up. There's a relationship there. And if they go down, stock prices go down, like in the middle of this chart. But in the last 10 years, because we've essentially created this manufactured, government-influenced monetary system, what we find is that if earnings aren't good, then the monetary policy creates adrenaline, it creates a drip, it creates medicine for the market. And so it kind of perks up the market. And so if news is expected to be weak for the economy, then investors are looking at the Fed saying, well, hey, you're going to allow us to have cheap money for longer. So that in turn pushes stock prices up on the left-hand side, right? So stock prices can go higher because people are anticipating cheap money and leverage and all that for an extended period of time. Or if things slow down just a little bit, but not so much that is going to require the Fed to act or to provide more stimulus, then stock prices would fall. And ultimately, the issue is that we're on the left-hand side of this right now. GDP is greater than 2%, but it's not growing fast. For us to get to a healthy, long-term, sustainable path, we got to go through the middle of this graph, and we got to be able to understand volatility is going to come with that. And I think we want to capitalize on that volatility.
That's the key. So the volatility doesn't have to necessarily be a bad thing. If we can protect, it creates a buying opportunity. So if we can protect, then I personally like to buy things as cheap as I can. So you kind of want that volatility to re-enter at a nice level, and we can come through that dip just fine, maybe even to the really good. But
I had a question in a meeting the other day. Somebody said, this makes perfect sense. They just said, how long is it going to take? Right, and which is a great question, because I mean, people are wondering, well, we obviously need to get to stable interest rate policy, and we need to get to economic growth that can be more organic, but how long does it take? And you know, if you look at demographics, I think it could take 3 to 10 years. I think it's not something that's overnight. So we have to be very diligent and very patient, try to make base hits along the way, but we definitely need to make sure we have a protection mechanism in place.
Yeah, and I think that's the key, is you want some level, we call it a defined risk mechanism, something that can get you out of the way while you're going through that to come out the other side looking better. And you know, classic diversification, we've talked about some bond issues and interest rates, that may not protect you to the level that it has in the past.
Right.
So having a strategy on top of assets, looking at being able to protect them through that dip, regardless of how long it takes, is prudent in our opinion.
So here's actually, that's a great segue, the next slide. These are our target portfolios for our portfolio models that we run here. And you can see the red and the blue, the dark blue are the stock pieces. The light blue is flexible, the green is more alternatives, and the light color there is your fixed income. But your risk generally comes from stocks. Like the ups and downs come from stocks more than most sectors. So if you're more aggressive, you're going to have more red and more blue, okay? Now, our defined risk strategy, which is a simple strategy that we use around the methodology around the 200-day moving average. If the market begins to trend below 200-day moving average, we take some off the table in the stock realm, okay? And we take more off the table for the more conservative client and less off the table for the aggressive client. So I'm going to advance the slide here, or you can, if you're looking at this on a PDF, just flip to the next page, and you can see page, model to model, that the pieces that go to gray that were currently were red or blue, those are the pieces that under the 200-day moving average would actually go to short-term bonds or cash. So like for a balanced income or inflation protection strategy, those strategies wouldn't have any stocks at all, any pure stock exposure, if we see the markets dip below that 200-day moving average. And that's just defining the risk. We're able to say that in those strategies, we know that the risk is you could lose essentially what the market produced in the last 200 days, give or take. That's what that strategy is designed to do, is to stop the larger losses on the downside. And we have that strategy because we looked back over the last 30 years and we can see that 85% or so of the worst days in the history of the markets occur when the market trends below that 200-day moving average. I think it's fear that builds on fear. So when things begin to trend down, people want to get out and it just accelerates. So we're not trying to time the market and get back in at the bottom. We just don't want to own it when it gets into that panic mode. And so as it sells off, we would either be risk off at that point, and when the 200-day moving average drops, as it would ultimately levelize, and the market recrosses that line to the upside, we would re-enter and resume our normal asset allocation. Very simple strategy, pretty low cost way to operate as well. But these two pages can help you see, depending on how much risk you have in your allocation, how much of that is hedged out when the market drops below the 200-day moving average. I would be, we'd be ignoring a big 800-pound gorilla in the room if we didn't at least mention something on politics with the great presidential election at hand. I think the one slide that we've got here that is relevant here is that how much of the political control is going to actually be obtained by either of these two candidates. At the moment, the Senate and the House of Representatives are controlled by the Republican Party. This slide is showing you how many delegates would have to swing from one side of the aisle to the other for that control to change. Now, what's interesting is that if the White House were to remain in the Democratic camp, then you'd still have some significant checks and balances between if it was President Clinton or against the House, there's some checks and balances. I think if Trump were to win the presidency, you still have checks and balances because the Speaker of the House doesn't buy Trump's policies. He doesn't support them lock and step. So I think, and because there's such a massive swing to move the House to the Democratic side, in political terms, it's incredibly unlikely. I think we're still going to have a very good balance of power, and that's going to create more, back and forth negotiations. Nobody's going to come in there and make sweeping changes because the House is not likely to change.
Yeah, regardless of your feelings or which one you hate more or anything like that. Our system.
Or you love them. You might love them.
Well, some, yeah,
right?
Maybe,
I don't know. Different people, different folks, different strokes, right?
Yeah, but it's energized right now, and but regardless of what happens, that person is not going to be able to swing things dramatically.
What the markets don't like is change. They don't like change. All of earnings for all the companies that are out there that every investor puts their money into, they're putting their money into because they made a calculated bet about what is this company going to produce in earnings. So if the political landscape changes, they can't calculate how much money they would think they're going to make. So when you have change, that's what, or real big policy changes, that's what gets Wall Street worked up. And I don't think you're seeing the market react to much of the debate because I don't think Wall Street and the investment community believes that either one of these candidates are going to create such change in the way things are done that it's going to change the way that these things are calculated.
Yeah, and look back at our Insert article that we sent out a week or two ago. People are always fired up around presidential election time, but when you look back historically just at the numbers, it just doesn't matter that much.
Yeah.
So
yeah,
I don't know that this time is incredibly different.
So we could have showed you a lot of things. We thought this was interesting. The House is pretty firm. The Senate and the White House are up for grabs. As far as risks that are out there, we'll wrap up with this piece, kind of going over our time here. There's two sectors that, if you look at, seem to be priced near their all-time highs in terms of their valuations, okay? It's the high-yield stocks, high-yield bonds, companies that take as much of their capital as they can possibly muster to pay it to you as a dividend, okay, which doesn't leave them money to grow. A lot of utility companies would meet that description. Those companies are priced at extremely high valuations relative to their long-term averages. The other place that we're seeing that is in real estate. Not every area, not necessarily residential, could be commercial, could be medical, could be office, could be industrial. But the real estate sector as a whole is extremely high valued at this time. And just if you believe in reversion to the mean over the long run, which most of us do, what goes up ends up, selling off more when you get that change in the cycle. So those are the sectors that we are having less exposure in right now, have biases against. But everything else seems to just be status quo. The election is very exciting, almost in a very strange way, entertaining to see what they're going to come up with day to day. I think that our political system and our forefathers that created our political process were pretty smart to have, the House and the Senate and the presidency and the checks and balances and the Supreme Court to oversee it all. I mean, I don't think that one person is going to change the fate of this nation. And we've got a very strong population that knows how to work. It's got a long-standing track record of resilience. We've got great strategies to diversify your portfolio, and we're having a pretty decent year. So these are the pros and the cons as we see it today. What's good and what's working? Unemployment is low, interest rates are low, earnings growth is positive, stock valuations are normal, slightly above average if anything, and the Federal Reserve remains pretty accommodative. What's bad is the political uncertainty. The leverage we talked about is a little high. Globally, growth is slow, and weak unemployment in terms of, weak employment pool. As the boomers retire, there's less people to fill those jobs. So we can't expect accelerating growth when we have a shrinking labor force. We're going to keep an eye on all these things as it impacts you and let you know. Thank you for joining us today, and Justin will take us through the disclosures.
Views are those of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information. The S&P 500 Index is an unmanaged index representing the largest 500 companies in the U.S. The Barclays Aggregate Index is an unmanaged index representing the overall broad bond market. Investors cannot invest directly in indices. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and fees and expenses associated with investing. Past performance does not guarantee future results.